Becoming consistently successful in trading is less about one perfect setup and more about a structured process. The traders who last treat it like a repeatable system: preparation, execution, risk control, review, and consistency. Here's a complete breakdown. 1. Foundation. What successful trading actually means. Success is not winning every trade. It is positive expectancy over many trades, controlled risk per trade, consistent execution of one edge, emotional stability under drawdown. A trader with a 45% win rate can still be very profitable if risk management is strong and winners are larger than losers. 2. Risk management, the core pillar. Risk management determines survival. Without it, even a great strategy fails. Key rules: risk a fixed percentage per trade, commonly 0.5 to 1% of account. Always define stop loss before entering. Never widen stop once in a trade. Daily max loss limit, example 2% account. Weekly max drawdown rule to pause and review. Position sizing formula in plain terms. Position size equals risk amount, entry minus stop distance. Example, account $10,000. Risk per trade, 1% 100. Entry $50. Stop 49.50 cents. Risk equals 50s. Shares equals $100, while 0.50 equals 200 shares. This keeps losses consistent regardless of setup. 3. A strong base strategy structure. Most reliable strategies follow this framework: higher time frame direction, middle time frame setup, lower time frame entry. Example trend continuation setup. Higher time frame stock above VWAP and trending up. Middle time frame pullback to moving average or key level. Lower time frame bullish candle, volume spike or break of micro resistance. Stop loss below pullback low. Target prior high or 2R. The goal is clarity. If rules are not clear, consistency is impossible. What makes a strategy proven? A proven strategy has clearly defined entry rules, clearly defined stop loss, clearly defined target or exit rule, fixed risk per trade, tested over many trades, minimum 30, ideally 100 plus, measured performance metrics. Without these, you don't have a strategy, you have a guess. Key metrics that define a great strategy: win rate alone does not determine profitability. A strategy with 40% win rate can outperform one with 70% win rate depending on reward size. The most important metric is expectancy, how much you make on average per trade. Expectancy equals PW times AW minus PL times AL, where PW equals the probability of win, AW equals average win is PL equals probability of loss, AL's average loss. If expectancy is positive, the strategy is profitable over time. Example, strategy A, win rate 70%, average win 1R, average loss 1R. Expectancy equals 7 times 1 minus 0.3 times 1 equals plus 0.4, profitable. Strategy B, win rate 45%, average win 2.5, or average loss 1R. Expectancy equals 0.45 times 2.5, 0.55 times 1 equals 0.575R. This is actually better, even with lower win rate. This is why risk reward matters more than just winning often. What numbers define a great strategy? There's no single perfect combination, but strong ranges are: solid strategy, win rate 45 to 60%, risk reward 1 to 1.5 to 1.2, expectancy with 0.25R or higher. Very strong strategy, win rate 50 to 65%, risk reward 1.2 plus expectancy plus 0.4R to plus 0.6R. Elite consistency, win rate 40 to 55%, risk reward 1.2 point plus, expectancy plus 0.6R plus. Notice none require 80 to 90% win rates. Those are usually unrealistic or require very small rewards. How to properly test a strategy. Step 1, define rules. Example, trend above VWAP, pullback to 9 EMA, entry on bullish candle, stop below pullback low, target prior high, 2R. Step 2, paper trade or replay charts. Take only those setups, no improvising. Step 3, track at least 30 trades. Record win-loss, R multiple, screenshot mistakes, market condition. Step 4, calculate stats. After 30 to 50 trades, calculate win rate, average R expectancy, max losing streak. Step 5, refine rules. You may find works better only in trending markets, fails midday, better with high volume stocks. Then narrow the conditions. Why testing matters psychologically. Testing builds confidence in drawdowns, discipline to follow rules, trust in your edge, reduced emotional decisions. Without testing, one losing trade feels like the strategy is broken. With testing, you know 5 losses in a row is normal for this system. That changes everything. What to avoid when testing: switching strategies mid-test, changing stop sizes randomly, ignoring losers and stats, taking almost, setups, testing too few trades. Consistency in testing equals reliable results. A simple example of a proven strategy profile: tested trades, 75, win rate 52%, average win 2.1 R, average loss 1 R, expectancy plus 0.55 R, max losing streak 6 trades. This is a very tradable system. You know, losses are normal, winners pay for them, long-term edge exists. That's what great strategy really means: statistically repeatable profitability, not just a setup that looks good. 4. Setup checklist before entering. Professional traders often use a checklist: market direction aligned, volume present, clear level, support resistance, moving average, risk to reward at least 1, 2, no major news risk, not chasing extended move. If 2 or more conditions are missing, skip the trade. 5. Stop loss placement. Stop losses should be logical, not random. Common placements: below support for long, above resistance for short, below pullback low, under VWAP intraday, ATR-based volatility stop avoid, tight stops in volatile stocks, plugs, moving stop, account killer. 6. Paper trading versus small live trading. Both have value, but they serve different purposes. Paper trading: test strategy rules, learn chart reading, practice entries, exits, build confidence. Minimum live money: introduces real emotions, tests discipline, shows execution mistakes, reveals fear greed issues. Best progression: 1. Paper trade until profitable for 20 to 30 trades. 2. Trade very small live size. 3. Increase size only after consistency. 4. Scale gradually. Jumping straight to large size is one of the biggest causes of failure. 7. Trading journal, critical for improvement. A journal converts experience into learning. Without it, mistakes repeat. Daily journaling is where most traders either accelerate or stall. The market gives feedback, but journaling is what converts that feedback into measurable improvement. Without it, mistakes repeat. With it, patterns become obvious. Why daily journaling matters: a journal does 3 things: tracks whether your strategy actually works, identifies execution mistakes versus strategy flaws, measures consistency over time. It also removes emotional bias. Many traders feel they're doing well, but the journal shows the truth. What to record for each trade: keep it structured and repeatable. A good entry includes date and time, ticker, strategy name, market condition, trend, choppy, news, entry price, stop loss, target, position size, risk in dollars or R, exit price, result in R, screenshot before entry, screenshot after exit, notes, mistake, perfect execution, early exit, etc. The most important field is result in R, not dollars. This keeps performance consistent regardless of size. Example: risk 1 R equal 100, profit $200, loss to $100 schools minus 1 R. Now you can compare trades effectively. Daily summary section, very important. After the trading day, add a daily recap. Total trades taken, total R gained, lost. Did you follow rules? Yes, no. Best trade and why, worst trade and why, one mistake to fix tomorrow. Emotional state: calm, rushed, revenge, patient. This builds self-awareness. Many traders discover their biggest issue isn't strategy, it's discipline. Weekly progress tracking. At the end of each week, review total R for the week, win rate, average win versus average loss, most profitable setup, most common mistake, best time of day, worst time of day. This is where you refine your edge. Example of useful journal insights: after 40 trades, you might see morning trades plus 12 R, midday trades minus 7 R, VWAP pullbacks 9 R, Breakout chasing, -6R. Now the improvement is obvious. Trade mornings, focus on pullbacks, avoid chasing. That's how journaling compounds performance. Track progress, not just trades. Add these daily metrics. Did I follow my risk rules? Did I overtrade? Did I take only 8 setups? Did I stop after max loss? Did I move stop loss? Score yourself 1 to 5 each day. You'll start to see disciplined trends. Consistency is more important than perfection. A great habit. Journal immediately after each trade, quick notes. Do full review after market close. Spend 10 to 15 minutes only. This keeps it sustainable. What separates beginners from improving traders? Beginner's journal, entry and exit only. Improving trader's journal, execution quality, emotions, mistakes, setup context, market condition. That deeper level is what leads to growth. Simple daily journal template. Trade section, strategy, entry, stop, target, result, R notes. Daily recap, trades taken, total R, followed rules, biggest mistake, best trade, improvement for tomorrow. Over 30 to 60 days, this becomes extremely powerful. You'll start to notice fewer impulsive trades, better entries, more patience, more consistent results. Successful traders don't just trade, they study their own behavior daily. 8. Metrics to track and journal. Track performance statistics, win rate, average win, average loss, expectancy, max drawdown, best strategy, worst strategy, time of day performance. You may discover morning trades profitable, midday not, trend trades strong, reversals weak, overtrading causing losses. These insights refine your edge. 9. Consistency rules. Consistency is built through discipline. Trade same hours daily, trade same setups, same risk per trade, same review routine, no revenge trading, stop after max daily loss. Treat trading like a process, not entertainment. Trading consistency is what turns a strategy into actual profits. Many traders find a solid setup, but results stay unstable because execution changes day to day. Consistency means you behave the same way regardless of wins, losses, or emotions. What trading consistency actually means, consistency is not winning every day. It means same setups, same risk per trade, same entry rules, same stop placement, same trading hours, same review routine. If your behavior changes, your results will also change. A good strategy cannot work if you apply it differently each time. Why consistency is the most important factor. Without consistency, you cannot measure your edge. You cannot trust your strategy. You cannot improve mistakes. You cannot control risk. For example, if you risk 1% one trade, 5% the next, and skip stops occasionally, your results become random. Even a profitable system will look inconsistent. Consistency turns randomness into data. Consistency in risk management. This is the easiest place to build discipline. Risk the same percentage every trade. Do not increase size after a win. Do not double down after a loss. Stop trading after max daily loss. Stable risk equals stable equity curve. Traders often break consistency by revenge trading, overconfidence after wins, fear after losses, changing position size emotionally. The goal is mechanical behavior, consistency and strategy execution. You should be able to describe your setup in one sentence and take it the same way every time. Example, trend direction, pull back to level, confirmation candle, enter, stop below structure. If sometimes you enter early, chase breakouts, skip confirmation, move stops, then you're no longer trading one strategy. You're trading emotions, consistency and daily routine. Successful traders follow a repeatable structure. Same pre-market preparation, same watch list criteria, same entry checklist, same journaling process, same review time. Routine reduces impulsive decisions. The brain performs better with repetition, consistency during losing streaks. This is where most traders fail. They switch strategies, increase size, trade more, remove stops. But losing streaks are normal even with profitable systems. If your testing showed win rate 50%, max losing streak 6 trades, then 4 losses in a row is expected. Consistency means continuing to execute, not abandoning the system. Think in probabilities, not individual trades. Consistency versus perfection. Consistency is more important than perfect entries. Trader A, perfect setup occasionally, inconsistent risk, emotional trades. Trader B, good setup consistently, fixed risk, follows rules daily. Trader B almost always wins long term. How to build consistency. Start with these rules. Trade only 1-2 setups. 2. Fixed risk per trade. 3. Maximum trades per day. Example 4. Stop trading after daily loss limit. 5. Journal every trade. 6. Review weekly. These boundaries force discipline. Consistency score idea. After each day, rate yourself. Followed strategy, followed risk rules, no revenge trades, journaled properly. Score 0-4. Your goal is high consistency score, not profit. Profit follows consistency, not the other way around. What consistent traders look like: small, controlled losses, gradual equity growth, fewer trades, calm decision making, same behavior daily. It's usually not dramatic, it's steady. Consistency is boring, but profitable. 10. Sample daily routine. Pre-market. Scan for high volume stocks. Mark key levels. Define market bias. Plan setups. During market, wait for A-plus setup. Execute only if checklist met. Respect stop loss. No impulsive trades. After market, screenshot trades. Fill journal. Review mistakes. Track stats. 11. Most common reasons traders fail: no risk management, overtrading, strategy hopping, moving stop losses, trading without journaling, trading too large too soon, emotional revenge trades. 12. What long-term success looks like. Month 1 to 3, learning and inconsistency. Month 3 to 6, strategy clarity and journaling. Month 6 to 12, improved discipline and small profits. Year 1 plus, scaling size slowly. The progression is gradual. Consistency compounds. In short, clear strategy plus strict risk management plus journaling, small sizing plus consistency equals sustainable trading success.